why job growth is bad for the economy. Of course, job growth, all else equal, is a positive thing. But in today's economy, job growth being up, more jobs entering the U.S. market than leaving the U.S. market is a lot more nuanced these days. There are some negative pieces to it that I'll highlight and could conclude in job growth turning around to the negative. We'll go full circle on this, how essentially job growth in 2023 could essentially conclude in job losses in 2024 or beyond. Of course, the timing of these things always difficult, but a really fun segment that we're going to speak to today. And it's no coincidence that July's non-farm payrolls for the last month of job growth come out tomorrow. They're expected at 225,000. That is much lower than the reading that we got in June for May. The reading then, as you can see here, I've highlighted, this is what the actual document looks like from the U.S. Bureau of Labor Statistics, came out at around 340,000 last month. Nearly 40% higher than this month's expectation. And that was a surprise to the upside. And we'll get to what that meant for the stock market in just a second. But the expectation here, not only lower than last month, but expected to be the second lowest reading in the last year plus of non-farm payrolls. The lowest measure in the last year was 217,000 jobs, as again, the lowest number being a really positive number, over 200,000. The economy has, and this is all synergetic with inflation, right? Jobs are flying around, money's flying around, inflation increasing the price of goods as more people have jobs, more people have money, and so on. And hopefully you can see kind of where we're getting at to in a second, because that inflation increasing has its effects on interest rates and then leading back to stocks, which we'll get to in a second. But let's actually start with the most immediate effect that we tend to see. In June's surprise, essentially more job growth than was expected led to, or not led to, but coincided with the S&P 500 making new highs year to date. You see here, we highlighted that day, and that was when the S&P 500 had made a new year-to-date high, a new high since the fall of 2022 there, falling on the same day. And so non-farm payrolls being a big weighty number that tends to cause reaction in every asset class, especially interest rates that we'll get to in a second. But I think relatively easy to make a case between these two events coinciding, non-farm payrolls coming out very, very positive, the stock market making year-to-date highs. And that is the short-term mind on this. It's what you would expect almost, right? Like, yeah, we get a good data point, the same as, GDP higher than expected. We're producing more. There are more jobs moving around than expected. That is a sign of, on the consumer level, there's probably more, money, better sentiment, but also on the business level, the corporate level, whatever you want to call it, people are hiring more. And that is, in a vacuum, a positive thing for the market at large. But this also has coincided with the yield curve getting back to an inversion of negative 100 basis points. You can see here that we put in a low. This is the 2-year versus the 10-year, got all the way down to an inversion of negative 100 basis points, or negative 1% in March, April range, turned around, headed back towards normalcy, which did coincide with, you'll remember March, what was going on then, the regional banking crisis, which was an inherently negative thing, and we'll unravel that in a second here. But as jobs came in last month better than expected, more job growth than expected, we actually took a turn for the more inverted, and now we're sitting at, as of yesterday, the largest inversion in the yield curve in 30 plus years. And you'll see that not only were the past inversions that we've seen in the yield curve, if you can see the yellow or orange line climbing above the blue line, that is a yield curve inversion. That's short-term rates jumping on top of long-term rates, literally the definition of a yield curve inversion there. And you'll see that that orange line climbs on top of the blue line there in 1999 2000 range. What happens right after that? The dot-com bubble bursts. The next time that you see that is in the 07, 08 range. What happens in 08? The financial crisis. Now, I don't want to jump on here and say one necessitates the other. Of course, that isn't true. Otherwise, the stock market would have already crashed, right? It's efficient like that. If it knew that inversion means that we have to crash, it would have done it the moment that the yield curve went inverted. But you can't help but look at this small sample size and say, I mean, these things happened in around the same time. And so I want to just quickly flesh out what's actually happening here, what happened in the past and what's happening now, how they're similar, how they're different. They're similar in that short-term rates cause inversions. They have the last couple of times, they are causing it this time. And what I mean by that is short-term rates are running up really high, and that's why they've caused this inversion. They've climbed higher than 10-year rates. Theoretically, you could see a yield curve inversion whereby interest rates are moving lower and 10-year rates just move way lower than 2-year rates. We don't have a data point for that. It hasn't occurred in at least the last 30 years that the U.S. Treasury has provided me data for. So with that being in mind, what's happening? Well, the reason that the stock market isn't crashing, even though that we're inverted and historically inversions have coincided with stock market crashes, is because we're inverted for a very normal and explainable reason. Inflation has set in the last year or two. The Fed, the central bank, they monitor inflation. That's like their number one thing that they monitor. They want to keep it not too low, not too high, medium, around 2%. And as inflation ran up, the central bank said, okay, well, we need to slow this down. We need to slow down our economic expansion, go into a contractionary period. What's the number one tool that they have? Short-term interest rates. They raise them to slow that down, bring that inflation back in line. And so at the same time, the central bank is saying, we see this inflation as being a serious problem. That's why we're acting. That's why they've hiked interest rates from 0% to 5%, and are playing at the fact that they might hike them another, half a percentage point to who knows, the market, we will see how high they get. Could be 6%, could be beyond. But they also have been saying inflation is transitory. They see it as being a couple of year process. And so if you're the 10-year or 30-year interest rate, you have been moving higher in tandem with short-term interest rates moving higher, but you're not fully buying in, right? Like if they said, oh, we see inflation is going to be a problem for 10, 20, 30 years, and so we're going to keep short-term interest rates that high for that long, then you would probably see the 10-year and the 20-year and 30-year bond move higher as well, and maybe that would unravel the inversion. And that could still unravel the inversion. But what we have seen, and this leads to the potential for a bigger job number being potentially negative for the economy, what we've seen in the past is short-term rates cause inversions, and they have also resolved them. And what I mean by that is 2-year or whatever short-term interest rate benchmark you want to look at, here we're looking at the 2-year, causes the inversion by running up high and fast. And then the last 2 times we've seen this inversion, there's been a stock market crash, some instability that you could partially peg to interest rates moving too high too fast and the economy not being able to digest that, companies, stocks, and everyday people not being able to digest that. And then the stock market has turned lower, and then the central bank, the Fed, has done the exact opposite of what they did in prior years. They've moved interest rates lower, and thus the inversion resolved to a normal environment where short-term rates come crashing down and longer-term rates move lower as well, but not by as much of an extent. Similar to if you are around options markets and volatility indices, you'll see sometimes if a big shocking event occurs, like the pandemic in 2020, short-term volatility will scream higher and medium-term volatility will move higher, but not by as much. Longer-term volatility will move higher, but by the least amount. It's a similar process here to the upside and downside. So what does this all mean about job growth? If the job growth number comes in better than expected, could, in the short term be good for the stock market. It moves higher on this Friday or in the next week or two or potentially months. But that would be a sign of, greater inflation, a need for higher interest rates, and an even greater yield curve inversion. And historically, we've seen these yield curve inversions only be resolved by a crash, which leads to negative job growth and a whole mess of problems there. So, of course, one doesn't necessitate the other. We'll see what happens with this non-farm number that is due here. But, job growth in this very nuanced economy could be potentially bad for it in the future.